Alrighty, Ken Range Theory Trader back with you with another video, just showing you the only play you need with fair value gaps, powered by the Candle Range Theory. So let's not waste time and get right into it. So obviously, people wonder what is a fair value gap. Put very simply, a fair value gap is just a spot on the chart where price moves so fast that it skipped a bunch of prices, and the market usually returns or retraces to trade through those skipped prices later. We see two examples of a bullish and bearish fair value gap. If you need more of a technical definition of that, you can see other videos. This video is not about that. But just know that this main middle candle here skips price so fast and so quick that the buyers are controlled. They have pushed price upward, and we just anticipate price to retrace back into this gap and then continue up. And then the adverse is also true for its other side, where sellers push price down so fast that price retraces back into this gap and then goes down again is our anticipation. Does it always happen? No, but knowing this, it can help us in the future because when it does play out, it can be very powerful. So when we combine this with this candle range theory, and of course, what is that? Obviously, every candle is a range, and it's a 2 or 3 candlestick pattern whereby we have a range candle, a manipulation candle, and then a distribution candle. Our focus being this third, distribution candle. We're looking to trade this price action after these two candles have already played out. So what happens when we combine the two of these concepts together? Let me take a quick drink of water and I'll get into it. So this is what we want to see. Okay, we want to see bullish fair value gaps and bullish candle range theory setups come together to give us explosive moves. So we have 1, 2, 3, and obviously once it retraces back into the fair value gap, we expect this third candle, okay, to expand to the upside, like I just showed you right here. So this price action inside of this fair value gap. Okay, so first you see the gap, then you see the candle range theory, and this price action is your expectation. Okay, and same for the opposite side. Okay, a bearish fair value gap, and then we have a bearish high, higher high, lower high, and then we expect an expansive move to the downside. So I like to do this on the 4-hour chart, or you can also use it on the daily chart. But all the examples I'm going to show you are going to be from the 4-hour chart. So this is from October of 2025, and we'll see how these play out. These yellow boxes here were bullish fair value gaps, but obviously when the gap fills, I have my indicator set up whereby it disappears. But we'll see here a 1300 or 1 p.m. Eastern Standard Time range candle, a 1700 or 5 o'clock p.m. Eastern Standard Time manipulation candle, and then the distribution starts at 9 p.m. or Asian session. Price shoots up inside of this fair value gap. It would have been green, if, like I said, if it wasn't filled in, but this large candle here created this gap in price because remember, buyers push the price up so far that price retraces into it, and then all we do once price appears is we wait for a candle range theory inside the gap, and then bang, that happens. Okay, that was good for 150 pips in 4 hours. We have another one right here where we have a 159 all AM Eastern Standard Time. So you have the range candle, the manipulation candle, and in 3 candles or 4, 8, 12 hours, price went up 130 pips. So you see the power in this. And then to the other side as well, we have a bearish fair value gap that was created right here. And then we have a 159 AM Eastern Standard Time, and price went down 70 pips in 4 hours. Awesome. We have some consolidation here, and you'll see this where price will retrace into it. But the thing is, there weren't any clean candle range theory setups that I saw here. The best one actually didn't come until right here. We have a 5-9 pattern. This is a 2 candlestick pattern where this candle is the range candle at 5. 9 a.m. sweeps that high and then closes down for 54 pips. And another 159 here off of this gap where we have the 1 a.m. range candle, the 5 a.m. manipulation, and then distribution down for 76 pips. So 1, 2, 3 candle pattern. This was a 2 candlestick pattern. The rest of these are still 2 candlestick patterns. Okay, so there are 3 candlestick patterns. So that's how that works out. So here are a few more examples from the 4-hour chart. I actually took this trade today. This is a 159 pattern off of this 4-hour fair value gap. This is a 4-hour chart. So this is a 1 a.m. range candle. Manipulation candle dips down into the range, closes back inside, and then boom. Okay, this was an easy profit for me. It was very simple. Here was another one. We have this large fair value gap here. So if you're using this method, you're not trading all up here. You're going to be patient and wait for price to eventually retrace into the gap. Okay, now it's touching into the gap. You have a 5 a.m. range candle here, the 9 a.m. manipulation here, and then your expectation is an expansion to the upside, and it did so for 8 hours. 1, 2, okay? Now that was good for 50 pips had you got in and gotten this expansion move to the upside. Let's see, and then here's a couple of bearish examples. So you had a fair value gap here on the 4-hour chart. You have the range candle at 5, the 9, and then the 1. And for 3 candles, this went down 59 pips on New Zealand dollar, US dollar. Okay, so you could have gotten all that using this method. And another one whereby you have this large fair value gap on the 4-hour. Price retraces back into it. But remember, the candle range theory doesn't play out until right here. 1, 5, and a 9 to the downside right here. This is your trading candle right here. Okay, so that was that. So you can use this method on the daily chart. So this is a daily chart. This was a Monday, Tuesday, Wednesday candle range theory. I didn't measure it, but as you can see, the price action is the same no matter the time frame. But going below a daily chart to me is a waste of time. I'm sorry, going below a 4-hour chart is a waste of time. Okay, so it's best on the daily or 4-hour chart. But this is one example of it on the daily 4-hour, and another one here. This would have been a Thursday, Friday. This doji candle here was Friday. Thursday opened, went below, and then closed all the way up here off of this daily fair value gap right here. So that's how that worked out. So in conclusion, okay, this isn't required. You don't have to use fair value gaps. Okay, this might give you extra confirmation, but always remember nothing's guaranteed in trading. Okay, sometimes things work, but other times they do fail. So manage risk. If you only want to trade fair value gaps in with the CRT, that is fine. But at the same time, remember you'll limit your options because you'll see some candle range theory patterns that still work out, and there's not a fair value gap in sight. It is what it is. So can this be a good addition to filter out some trades? Yes. But if you stick to it and make that a condition of your trading, you will miss some setups. So just be aware of that. I prefer fair value gaps that have not been touched. So that means that price has never retraced into it. It's like their first time going back into it, like we saw on this chart, right? Well, I could just use this one right here. So see here, you had 1, 2, 3, and then this gap remained untouched until right here, the low of the Tuesday candle. Barely spiked into it and then exploded up the next day. It did get touched again right here, and even though this did play out, to me, I like this setup better instead of this one right here. I didn't mark this one because I just didn't want to. But you see here, it did still play out. So sometimes you'll have that, but my preference is always the first touch. First touch of the gap right here. This one right here, first touch of the gap. And this gap right here hasn't even been mitigated yet. So that's that. Like I said, I prefer the 4-hour fair value gaps because the feedback is going to be faster. I don't like nursing trades overnight. Eventually, all fair value gaps will get filled, so count on that. So just because you see it one day or one 4-hour block doesn't mean that it's going to stay there forever. It's not. Price will eventually come back down and wipe it out. But just manage risk and you will be fine. So this is just the teaser video to hopefully get you on the chart for yourself, because remember, you'll learn more from the chart than you'll ever learn from a video. You have to put in the chart time to train your brain to look for certain patterns to play out and where you want them to play out. Okay. Everything else is still going to be the same. It's just now that we're adding a fair value gap to the mix, you'll be able to anticipate price showing those rocket moves after the gap gets teased into. So I hope that helps. That's the best way to combine fair value gaps and candle range theory into one to make you a trading machine. I appreciate your time and attention. I hope you have a great rest of your day. Get on those charts, back test, and you'll see some results, I promise. So thanks for your time and have a great rest of your day.